So we'll get the questions from there. Okay, okay. Let's roll.
I think you start.
Okay. Hi everyone. Thanks for joining Calvin and I on a Saturday night. As we chit chat and talk about stocks. And one thing that we were discussing in our own conversations recently was about the Magnificent Seven, of course, and how we each analyze stocks, how we value, because we thought that it would be interesting to learn from the different perspectives of how each different investor looks and value and decide whether a stock is worth it for them. Yeah, so today but we thought like instead of just hearing us chit chat and then just talk about like stock, we thought we'll also put together something that gained quite a good traction during my earlier January workshop, which I ran for free for my community, and that it'll be a good idea to run part of that together with this chit chat session. So we are going to talk about. Kevin, are you sharing the your slides first? The agenda. Yeah, so we're gonna talk about how you can invest your spare cash, how to automate your investments, some options and ways to do so, because the common question is I don't have time, so how do I get started? How can I automate it so I don't have to think about it and let it run in the background for me? Right. So we're gonna answer that. And then we're gonna, of course, this is like the bow and the main one, how to find winning stocks, where to find them, how to discern if they're winning stocks or not, and finally how you can determine whether a stock is undervalued. And because right now the Magnificent Seven is getting a lot of attention, of course that's also something that we are discussing, so we're going to run a live analysis on one of the Mag 7. So you can guess and put in the comments what you want to see, but we'll only pick one to run today. So yeah, let's go, Kelvin.
Okay, let me just share screen a bit. Hi guys, by the way, if you are from Budget Bits side, yeah, because we are streaming this on both sides lah. So, okay, I'll just share my screen. Wait, first time doing this, so bear with me a bit.
And the genesis of how this conversation and this came about is because like Carrie and I were discussing about how we each value stocks, right? And then we thought like, okay, why don't we get on a session to really discuss it? They're like, actually, why don't we just combine it with a few other stuff? Then it's not just the two of us chit chatting, but also more of you guys can come in, listen, and give us your comments and your feedback, or you can like dispute, you can agree, whatever it is, you can share more, and it's just a more holistic discussion altogether. So yeah, we prepared this, and we hope that you'll learn something out of it.
Okay, can see the slide, right?
Yep.
Okay, so I guess this session is like how to find undervalued stocks. That's actually like Budget Bits side. But mine is more like how to invest your spare cash lah. Here's some disclaimer. Okay, how to put your idle cash to good use. I will start with the basics first lah. So I think it's not always about like how to earn the most yield, how to earn the most return on your cash lah, because you also need to see when do you need your cash. So for example, let's say if you need your cash right now, like maybe your emergency funds, like maybe your Netflix, you need it to take your bus, buy your Chai fund or whatever, then that money can only be parked in all those high yield savings account and money market funds. Uh, those accounts right now are giving about 4% yield. So for example, like UOB1, money market funds, those kind. Then if you do not need the money for the next 6 to 12 months, then you can look into parking into like fixed deposits, money market funds, and those Singapore savings bonds, and so on. For those, I guess you need to lock in your fund, lock in the money for within that period, so you won't be able to access it immediately, as compared to parking the money in the banks. Then after that, if you don't need the money within the next 1 to 10 years, you can look to park into bonds. So like Singapore savings bonds, right now I think it's giving about 3% plus minus lah, or even like T-bills. T-bills maybe 6 to 12 months lah. If you want longer period, then it will be like SGS bonds. Then if you even longer, if you don't need the money within the next 10 years, then then look to park into stocks because stocks can give you a much higher yield as compared to all the rest. So I think the lesson here is more like, when do you need your cash? Because if you do not need your cash within the next 10 years, then it's best to park into bonds. Otherwise, if you are parking your emergency funds, like for example, if you park your emergency funds into stocks, then if you crash, then you straight away lose your emergency funds. Then it wouldn't be fun. So here's why. So in the long term, stocks will always give the highest return. If you look at historical data. Then if you park your cash into money market funds, right now, even though it looks like very attractive, like 4%, near to 4% for SGD money market funds and about 5% for USD money market funds, just take note that this you will go down starting around the middle of this year when the Fed start to lower interest rates. So yeah, by then people will start, when the rates go down, people from money market funds will move their money over to somewhere else that can give a much higher return. So for example, like stocks. So that's when money market funds yield will start to go down. So then you are left like end up with a much lower yield. So you need to be clear on where you should park your money, where is the best place to park your money depending on different time frames. And here's, so for high savings accounts, the best account right now is still the UOB one, because you only need to fulfill the crediting salary criteria and the credit card spend criteria. For UOB one, right, they have one special thing is that you, for crediting salary crediting criteria, you only need to fulfill, you can actually do it by yourself because they support the pay now method. So let's say your salary goes into your DBS account, you can pay now from DBS over to UOB and select the salary crediting criteria, and you still fulfill the salary crediting criteria if you select the salary as the purpose of transfer. So that's the good thing about UOB one account. Right now it's giving about 3.85% interest. For OCBC 360 is a bit harder, but still doable. So, and lastly, for Berry Bank, it doesn't have any like criteria. So if you're like someone like freelancer, housewife, retiree, this kind, like, so 2.8% interest will be what you can get for practically no criteria at all. Just put your money there straight away under interest. Okay, so then the next one, if you're unable to fulfill the bank interest, a bank criteria, and if you don't want the Merry Bank lower interest, then you can look to money market funds. So money market funds, they are taking the money and investing into like bonds, uh, banks, fixed deposit, those kind of stuff, corporate stuff, and bank stuff. But because those are investments, so they have a bit of risk towards it, and they are not guaranteed by like the SIPC insurance. So just take note, just be aware of this kind of risk. So money market funds, I think right now every broker are offering it. Momo, Weibo, Tiger, they're giving about 3.8%. So if your main broker are this broker, the good thing is that you can just put your money there. If you don't need the money, your spare cash will be earning all this either return, not really interest. I would call it a return instead. And for USD, if convert to USD, they will earn the USD yield, which about 5% plus minus. So whenever you need the money can be instantly redeemed from all these money market funds straight away to be invested without any delay. Then recently I also discovered that UOB AM Invest also came out with this cash plus extra thing. There is a combination of two funds like, so UOB AM money market fund and UOB fund. The yield is slightly higher, so obviously you can expect slightly higher risk as compared to normal money market funds from the brokers. So it's something to look at. Higher risk, higher yield, higher return, higher risk, sort of thing. But I'll be covering it soon, so you can wait for that. So then lastly, the bonds are for your longer term. If you need it, if you don't need the money within the next 6 months to within the next 10 years, bonds will be your next choice. So you can look at like T-bills, SSB, or even all those the Great SP from Great Eastern is giving a guaranteed 3.5% per annum for 2 years. Uh, for me personally, I'm parking my money, my emergency funds, some of it in SSB, because the money is redeemable within 1 year, and I can lock in the yield for 10 years. So if the rate goes down, I will still get this kind of average yield. Like currently it's about 3% kind of yield for the next 10 years. So that's great. And for my CPF OA, I'm actually parking them in T-bills. So I'm getting a slightly higher yield as compared to the CPF OA of about 3. So CPF OA give about 2.5%. So by parking into T-bill, I'm getting like 3.78% for in the latest tranche. Okay. And lastly, for fixed deposit, I would say for fixed deposit, right, there's the bank fixed deposit, and there's the robo-advisor sort of fixed deposit. It's not really fixed deposit, but the robo-advisor is taking the money and investing it in fixed deposits. Uh, from what I can see, right, robo-advisor fixed deposit, but they call it like, so for SIFE, they are calling it SIFE guaranteed, SIFE cash guaranteed lah. Stashaway also has their own. So there are two brokers offering this kind of fixed deposit kind of thing. From my experience, they are giving slightly higher yield because I think they are doing some negotiation with the bank, and they are able to get slightly higher yield. But the downside is that if it's also not guaranteed, so you can also think of it as an investment. So if you are scared, just go with bank fixed deposit. So here's the tip. There's this website called sgft.neocities.org. You can use it to look for the bank's best FD rates by the bank every month. So it's quite updated. Yes. Okay, so then lastly, for all your money that you don't need within the next 10 years, it's best to park into stocks to get the highest return possible. So here's the lesson that I learned within the past 2 years. Because I was like manually investing my money, and the market just dipped and went straight back up. I actually missed the bottom. So quite regretted it. So the reason this kind of thing happened, right, is because the 10 best days and the 10 worst days in the market usually occur within 1 or 2 weeks between one another. So for example, you look at like the 2008 period, after the big crash, right, in September, then in October, straight away, there were like there were two huge rally. So same for the 2020 crash. You remember that big dip after that? Every day the market was crashing. Then immediately after that, the market straight away went back up. I think this also happened around the 2022, end of 2022 period also. The market was crashing. Then suddenly it went up, and it has gone up all the way until right now. So we are at all-time high for S&P and the Nasdaq, but not for Tesla. Tesla went down. Okay, so here's the crazy part. So they look at like if you have invested this $10,000 from 2002 to 2021, so over the period of 20 years, right? If you stay fully invested, your average return would be 9.5% every year for the past 20 years. But if you had just missed the 10 best days in the market, your 9% return would drop by half, down to 5% average return per year. So this is just by missing out 10 best days in a 20-year period. So this will happen if you try to time the market and suddenly the market U-turns, like what happened in 2008 and 2020. Your returns will instantly cut by half already. If you miss 20 best days, your returns will be just like CPF OA kind of return already. You might as well like just put your money in CPF, not financial advice. Yeah, so, and if you just miss like just 40 best days, so 20 years, you miss 30 days of the best days. So you straight away get a negative return. So might as well don't invest already by then. So I think the hardest part about investing is not to choose stocks. I would argue that it's actually quite not too hard to choose stocks. Just go with those like ETF, like S&P 500 ETF, like even if you want STI ETF or bank stocks, those kind. These are all quite stable kind of investments, right? But the hardest part is not investing regularly and you are trying to time the market all the time. Oh, and imagine doing this for like 30, 40 years. You are trying to in out all the time. And you are so the biggest risk in the market is not the market, it's actually yourself. You're trying to actively sabotaging yourself by trying to time the market. So I, my solution to this is to just automate your investments. So right now every broker has this kind of thing. Like for Weibo, not sponsored by them, of course. Weibo has this regular savings plan. Mumu also has this IBKR Tiger. Basically every broker has this lah. So for this, you can see that okay, for Weibo, you can just go to a stock that you want. You turn on regular savings plan. It lets you invest with as little as $10. And the good thing is that all the local brokers let you deduct the money directly from your bank. So you don't have to set up transfer. You don't have to transfer the money there. So you set up once you set up every month your salary comes in. You just set it like at the beginning of the month. Then you will automatically pull the money from a bank account to invest in your stock. You can choose it anywhere from every trading day all the way to every month. So if you just do this, is it's hard to miss the market bottom lah because you are consistently investing all the time. So
Question, Kevin. We
yeah,
often see this chart being shared about how if you miss the best versus the
it's-
worst days, right? But then when it comes to automating, what would be a good frequency that you think most people should be automating on? Would that be every week, every month, every trading day? Because if you do every week or every month, then you might still miss the best days, right?
actually I think it doesn't really matter as long as you are investing consistently, whether it's every day lah or every month. In fact, every month I suspect it will be quite painful because you are incurring a daily trading fee.
Mm.
For IBKR, it's not that painful lah because IBKR fee is only like 35 cents. So 1 month is 35 times 3, $9. Yes. But for local brokers, their fee is slightly higher. So uh, some people in my Telegram group, they are actually dollar cost averaging every day lah, which
Oh, wow.
I'm quite impressed lah. But for me, I'm just doing it every fortnight, means every 2 weeks lah.
Mm.
Uh,
Looks like there is no common consensus, right? So a lot of people they do every
yeah.
month when the pay comes in because that's just easy. And then you're saying that in your group, your community, you see some people do it daily. For yourself, you've chosen fortnightly. So how can someone who's listening to this video then decide what is a good frequency for them?
I think just start with an monthly low, because if you there's it's always like, do you try to time the market or not time the market? But if you look at the frequency, I don't think it really matters though. Like okay, let's say if you do it every day, you might get a smoother chart as compared to someone who is doing it every month. But I don't think there's a big difference between the two lah. Yeah,
Over the long run, right?
yeah, over the long run, that's the key. Yes. Okay. I think my side is done.
Okay, I
It's
guess it's
very fast.
my
Yeah, so that's
turn.
yes. Thank you.
Thanks for sharing all your research, Kavin. I think that's important. And we always start with this because when we have idle cash, a lot of people, the first thing they want to do is, okay, I got like X amount of dollars right now, right? Like I have 10,000 or 20,000 or whatever the amount is for them. They will always like to ask, what should I invest in? What should I buy? I think actually you should be taking baby steps. The first thing is really like before you know what to buy, maybe parking your idle cash in somewhere where you're earning better than 0.05% is the first move to make, right? And then like if you haven't yet decided, put it into like T-bills or FD first. But then once you have done your research, you know how to invest, you've accumulated the skill set, then it's really about moving out of these. So the idle cash portion should always be idle cash where we have cash war chest for if the market were to crash, or emergency funds that we need urgently to liquidate anytime. So that should be that step. And then after that, go along the way. So I love what you cover on automated investing. I think that's one of the biggest themes right now, especially because the S&P have gone up so much. And on the internet, everyone is just talking about how like, yeah, just buy S&P, right? The S&P has given like 8 to 10% CAGR over the last few years. That would have been an easy yes decision that you would have made for investing. But I think that is actually quite short-sighted. And we're going to zoom out today to show why that may not be the complete picture. But more importantly, after we set up that first foundation of automating, then we also want to try and get a bit more lah, right? Because the reality is that if we were to only invest in the market indexes, we only get market returns. So that's why Kelvin, you asked me why I pick stocks. And the reason really is because I don't want to just settle for market returns. I do a lot of analysis on company business models, economics, and the overall business climates and trends, right? And I want to be compensated for that time and earn better than market returns. And that's where working with individual stock picks, where we see that opportunity that grow, can give that outsized returns that just tracking the markets will not give us. So I'm going to talk about all the different tools, because one question we always get from lots of people who are starting is, how do I decide what investment tool is best? So let me see, how do I share? Here we go. Okay. So how do we then discern which is best for you? And you is worded big, bold in green, because everyone's choice can differ, and really the best investment is the one that fits your circumstances, your risk appetite, and something that you can stick with for the longer term. So these are typically many of the different tools out there, the different options that you can put your money in. All the unit trust and the mutual fund folks will say, hey, buy us. The indexes don't really market themselves as much, but there are bound to be other people, and the general advice online is buy the index. And then of course you have your insurance companies and FA selling you investment link plans. You have people talking about equity, stocks, bonds, and then there's also cryptos, that option which Kelvin, I know you do quite a bit on. And then there's also that whole divide between technical analysis, charting, reading like moving averages, RSI, Bollinger Bands, so on and so forth, versus like doing fundamental analysis on the company. So we're gonna walk through all of that. And I thought this by DBS is actually a great visual to help people understand where the risk and the potential returns could be in each option. So we look at inflation as that middle line, right? If you're just sticking with your bank deposits, your savings accounts, you are not likely to beat inflation in the long run. And yes, it's great that we have high yield savings account now, but I think many people, especially when they start out, they make the mistake of thinking, I just park my money in a high yield savings account, I'm good. I see people online say that is investing. It's not. Okay, so you are not going to beat inflation in the long run if you just stick with that. But we need to go even further. So the next one would then be government savings bonds or the T-bills. But by the nature of how the financial markets we work, that alone is also not enough. We can barely keep up with inflation if we do that. Not to mention it's quite tiring. Yeah, people have built like SSB ladders, which are great. And then T-bills, typically they are like 6 months or 1 year, so you have to keep rotating your cash, and that can get quite tiring when the returns is right now only single digit, right? Well, it's good, but it's so much effort for just single digit. So unless you have like huge amount of funds where that single digit is a lot, then okay, that makes sense. But if you're on a smaller capital, then that effort, is it really worth it? So we need to answer those questions for ourselves, right? Then there's also endowment plans, but I think overall endowment plans have not really been keeping up, so they're getting worse and worse as the years go by. We have to see how that scene changes in time to come. Then of course there's unit trusts or ETFs, and there's also stocks, and then of course cryptos like the far end lah, right? So high risk, high return. High volatility as well, but this is in general a good risk to return framework that people can use to think about. And I think what's more important is, I always tell my readers, right, is that when they ask me, Don, what should I invest in? Should I buy the ILP? Should I buy stock? What ETF? Whatever it is. I'm like, at the end of the day, do you really understand how each works and what are the associated trade-offs that you're giving? So that's what I was mentioning earlier on. If someone simply just invests in market indexes, good. but you're only going to be getting benchmark market returns, right? If you invest in a actively managed fund that aims to track a certain index, then your actual returns will be slightly less because of the cost involved as well, but it will still trend in that same direction. Okay, but if someone wants like alpha, beat the markets, then we have to work harder, right? It's not going to be easy to beat the market. We need to put in effort. Sometimes luck helps as well. But if we understand what's needed in each stage, then we can better make the decisions that work for us. And that's why, like for myself, beyond just the foundation, I do pick stocks. I do pick crypto because that is where I see the outsized gains coming from, the multi-baggers. So a quick summary of each of them, right? For those of you who might be listening and are not familiar with each instrument, I hope this will help you get a quick crash course. So basically, if you're looking at unit trusts, mutual funds, or indexes, these are quite easy. Okay, they make it simple, convenient, but the reality is you're not going to beat the market. You're just going to be getting market returns or slightly less than market returns. Then the next one would be investment linked plans. I think the good thing is that investment linked plans in recent years have actually transformed, and they are better than old investment linked plans where the insurance component and the cost really rose like crazy. Today, I think because of all that bad flag that the old style of ILPs were getting, modern day ILPs are slightly better, but the trade-off is still there. It's higher fees, right? Because there's so many layers of middlemen that need to get paid. Okay, and then but in return for the higher fees, what we usually get told is that there's a potential for market beating alpha, and more importantly, the value of an ILP really, I think, is that it guarantees someone's discipline for them, because there is such a huge penalty if you stop your ILP prematurely. So it makes up for your emotional weakness if you are not disciplined about your investing. And ILP is a way to force you to be disciplined, but you have to pay a cost for it. Lah. So the higher fees, you have to think of these pros and cons and then decide if that is useful for you, right? And then there's also equities versus stock. So very much needed for more effort, but the returns, the multi-bagger gains, can be really worth all that while. And of course, there's bonds. Bonds are low returns generally. And there are corporate bonds that you can push the yield a little higher, but at the end of the day, it's very, very hard to rely purely on a bond strategy to beat inflation. But the good thing is that it's guaranteed payback for most bonds, lah, right? As long as you go for the higher quality, safer bond issuers. So the capital safety there is better versus the volatility in equities and stocks. So that is how bonds trade-off work. Then there's crypto, very volatile. A lot of scams as well, but it's possible, and it's probably one of the only places in the financial markets that someone can get 100 times returns. It's possible, right? Like 10x your money, 100x your money, very possible in crypto because it's such a wild west right now. But the trade-off is also very volatile, right? And there's so many scams that you need to wade through. So if someone is not well versed in that, then crypto will require a bit more homework, or otherwise find a way to either minimize your work or just don't invest in something you don't understand, lah. Right. And of course, there's options trading, there's TA versus FA, and I actually did try, right? So Calvin, I love what you do with options trading, and I really want to know more as well on how that can fit. But I think my limitation with options for myself was that it required quite a bit of effort and fast response. Like I needed to be able to react quickly if things change. And because of the leverage, right, where you can potentially lose more than your capital depending on how you structure it. So that was something that I wasn't very comfortable with. But I like how you did it like an insurance style payout, so regular income. I thought that was safer. But for people who are like my position, I am a working mom, right? And then I also have 2 young kids. And also like I do my blog, my writing on the side. So there's very little time that I have outside of all these, where I only now spend on studying the market, studying the stocks that I'm interested, that I am invested in. So I don't really have a lot of bandwidth left to do all this stuff. Yeah, but I can understand why that works. So it's not that it's bad, but really just knowing that it may not fit your life circumstances. I tried and I figured I really am not suited for it because I cannot commit what is required of me. So I think this is an overall view. Calvin, is there anything you want to add on this table? Like anything I didn't cover that you think people should know?
I'll just add for options lah. I think options it sounds easy, right? People see my video, oh, they can go and try it, then they realize it's not as easy. So there's a bit of learning curve lah. Because for options, it relies on probability. That so let's say if you sell option 30 days away, it relies a lot on probability. So for every, like, let's say 2 trade you make, maybe one trade will wipe out all the previous trades. So you have to find an edge lah. So it's not as easy as you may think. You need to find the edge in the market. So it requires a bit of TA also. Yeah.
Yeah. So I hope if you guys have any questions, please leave it on the YouTube link. We'll come to it at the end. But yeah, this is the overview, and this is like a one glance to understand your trade-offs. If you're interested in any instrument, please go and do more research and more due diligence. But this is a quick introduction. So okay, I wanted to just chit chat a bit about how most people invest. So I think the first method is, we hear about things online, especially in the last 2 to 3 years, right? When people were stuck at home, then FinTalk and financial literacy suddenly became very hip. I remember before that, right? Calvin is like, when we talk about FIRE, no one's really interested. Everyone's like bored, right? And then suddenly, when during the lockdown, there was just so much interest in financial literacy and how to invest. And then we saw that very exciting GameStop saga and rally, and it's just crazy. And a lot of meme stock started to come top market, right? Like there were names like Peloton that I had never heard of before, but because it was like, COVID relevant, stuck at home, so exercise at home, buy the bike, and then clock your fitness, right? And then the rise of fitness YouTubers. I remember like this fitness YouTuber I was following for DIY workouts in 2019 pre-COVID, right? And her following wasn't very big, like 6 digits. And during COVID, she grew to like several million. Now she's like 20 million. I'm like, wow, that's just tremendous, crazy growth, unprecedented. COVID was also unprecedented, right? So, but because of how things moved during that past few years, and people who started investing in that time, like that was your first foray into investing, I think a lot of them fell into this trap of buying what other people were talking about. And normal, right? Because like, oh, if I don't know anything, I'm just starting, I'm gonna watch like TikTok, YouTube, and all these social media channels, and then I'll see what people are talking about, and I'll buy that stock. And stocks like Peloton was very popular back then. And just look at where it went to now. At its peak, Peloton was 160 USD. Now it's like $4. That's very painful, man. Very, very painful. Imagine like someone who put in just like $10,000 on, not just put in $10,000 into this, believing in all the shoes and the videos about Peloton going to the moon, and it's like very it's game changing, and the company is gonna grow at XX%, and then like look at where it is now, and it hasn't recovered, right? Like the markets have been hitting new highs in the last few months. Peloton stock is still sideways. It's still at $4 today. Yeah, this screenshot was taken on 15 March. Today it's like 23rd already, and it is still at about $4 plus. Yeah, so it's quite sad. And then there's also like the GameStop where they made that whole dumb money movie, right? And one thing I was thinking about, and I shared this line on my Instagram for folks who were following and asking me all these questions, was I introduced this line of thinking, which is, could we be their exit liquidity? So it's a line that I started, like I would ask myself every time I watch a shoe video. Like I see someone shilling Peloton or shilling Snowflake, and I'll be thinking like, is it that person, that YouTuber or that TikToker or whoever it is who is shilling it, bought already, and is shilling it to like go viral, get all the views, and then later that person just gonna dump on me? Right? They're gonna sell at the market at the high, and then like I'm gonna be stuck with the stock, because I think that's what happened with GameStop, right? Everyone was like just piling in, and a lot of people, some people made money on GameStop, but the reality is the one who made the most was Keith Giles. And Keith Giles got in before everyone else. No one knows how much he made exactly, but reports estimate that 35 million probably can retire already. Okay, so I like to introduce and use this line. Could we be their exit liquidity? And I feel it helps me to be a bit more skeptical of everything that I consume online. I still do want to watch people shield their stocks because I can learn a perspective that I may not have known or seen before. But I want to be very conscious of being emotionally swayed just because their energy is so infectious and everything. And I would think, yeah, could this person be making me their exit liquidity? And I think that helps with a lot of the decisions and that I have used as a result lah. Okay, then the other one is, I think this is a very common one. People would use market indexes, right? And Kevin, I think this is something you were exploring also, right? So but most of the time you want to go globally diversified, and I think for most people in Singapore at least, or in Asia, what we tend to do is we do home ground, we do S&P, then we do home ground, then we do like total international or world international, then we do like Nasdaq tech, because tech is like the next big thing, or has always been, but like this is the new revolution as they call it, right? And then like some people like pro China or believe in China's growth, then Hang Seng Index. So like if you put these 5 indexes together, actually the markets, we can see that S&P has gone up, the Nasdaq tech has gone up, but Hang Seng Index has gone down. Straits Time Index has been sideways, and international has been like that volatile, right? So if you put all of that together, it kind of balances each other out depending on the percentage allocation, right? Like if the person was all in on S&P, yes, the returns are very good, very easy decision. But most of us want to be globally diversified as well, and then that's where the negative on Hang Seng, for example, would cancel out some of the gains in S&P, so the returns wouldn't be that great. Okay, and it's not that it's wrong, but this is also another popular method on how most people invest. And if that's something that works for you, go and look into what counters make sense for you and what exposure you want to get. So I want to do a poll. Hey, is there a poll function on YouTube? How many would invest in this? So this is a particular market performance for 12 years. I think is there ability to look at oh yes, there's a comment thing, right?
Oh yeah, that's the comment.
Great. Okay, I can see. Yes. Oh, I think your YouTube audience are more engaged. Facebook, not really that engaged. I see a few, like very few. Okay, but guys, how many of you would invest in this? This is the performance for 12 years, huh?
Looks flat lah.
Maybe my internet lag, but okay, great. I'm seeing answers now. I see no. Okay, no, lots of no. Okay. Looks like global index. Wow. Nice. Netflix? No, not Netflix. Okay, so the answer is it's actually the S&P 500. Now, if you put that into context, everyone is saying online buying the S&P 500, right? It's gone up so much. But a lot of us forget about the lost decade. And it's not anyone's fault, because there's this thing called recency bias. If we didn't live through it, or even if we lived through it, but it was some time ago, right, we tend to forget. Our memory tends to remember things that happen in the nearer term. So I thought it was very interesting because no one said yes in the comments. But online, everyone is just endorsing. If you go on all the you go on social media, you go on Reddit, right? Everyone just say just buy S&P, buy S&P, buy S&P, right? Instagram, buy S&P. And like, okay, but what if we had another lost decade? It looks very nice on the right hand, right side of it, right? Because it's just gone up. But what if that yellow portion repeats itself? And no one knows what the future will hold. So we really don't know. I guess like if you believe that it won't, then invest based on your beliefs. But for me, I don't want to put all my eggs in one basket, and I'm mindful of what is the worst scenario that could happen. So I try to factor in all these biases when I make my investing decisions. And if we look at equity markets, right, over time, okay, from 1899 all the way until this year, the reality is actually different markets have had different, different ins and outs. So what's interesting is Japan, right? I think if we ask our parents, most people in that generation will probably remember when Japan was very popular and Japan stocks were like doing very well, so on and so forth. But then the thing is that then later on, like Japan did very trade already, right? US had lots of great runs, but there's also been times when it wasn't great. So at the end of the day, I think this is a good time to remember that while we are all very excited about the S&P going up and breaking new record highs every other week, it seems, we should also be mindful that that may not always be the case. It could still continue, definitely, but if we are mindful that the US did indeed have a lost decade and think about that when we make our decisions, then maybe it would lead us to potentially reduce our exposure to just the US market or make other decisions around it. Yeah, so just factor that in. Okay, we're not saying that investing in S&P is wrong. By no means is that the advice, but the key thing is that there don't just look at it doing well recently and then take it that, oh, that great performance is going to continue. Yeah, so there's no answer lah. Okay, but it's really just thinking framework to factor in. So Keith from Investment Modes actually wrote this article in January 2023 last year, and it's a really good read. If you guys haven't seen it, please go and check it out. You can just type in investmentmodes.com and this title, are we returning to the 2000 to 2010 investment climate where everything did better than the S&P 500. So digest the data there and make do with what you want out of it. Yeah, but I think just wanted to pull out some key points, which is that in the 1990s, US stocks caught up and it was a very good run, it tripled. Right. But then in the 2000s, and I vaguely remember that time, okay, I was much younger then, but I vaguely remember in the news and everything, international stocks, Asia, China was starting to regain the lead. But then since the start of the 2010s, and I remember this very well also, the US stocks have really just like gone on to keep breaking new highs, printed ahead. I guess the question that we all want to know is what's next. But most of us only remember since the start of the 2010s. So this is a reminder to zoom out and then make do with the information what you want with it. Okay, and the JP Morgan also had these cycles where they measured the US equity outperformance versus the world global foreign global developed lah. Okay, and this is the difference in the returns. So when they measured during the period of 1970 to 1989, this was the returns where foreign stocks was better than US stocks. Okay, and it depends on each period that you measure, you're gonna get a different number, but it's worth this main message here is that there were periods, and that's like, almost 20 years, when foreign stocks actually outperform US stocks. We don't know if that's going to happen as long as US still maintains like world supremacy. I think we can do pretty, S&P will be quite safe at least, but need to factor in that it may not always be the case as well. It hasn't always been the case, and we need to think about that when we make our decisions. Okay, so okay, my key issue now with S&P 500, and I need to disclaim first. Okay, I don't feel comfortable when things are at record highs. So the budget big in me, I'll really be like, I'm not buying it at a discount. So I don't want to buy. I want to buy more when it's on discount and like tune back a bit lesser when I feel that it is overvalued. I don't think I'm great at timing the markets. And even if I was, I wouldn't be able to get it right all the time. And I know that very well. But today's SPX, I feel, is just like I don't know. I just feel that it is really, there is little margin of safety. So it's great if it keeps performing well, right? But as a value person, I tend to want to invest when it is at the average or it is like, below one standard deviation. That's what I will look at lah to assess whether it's undervalued. So I will factor in a few things like what is the fear and greed index right now? What is the average been for the last 10, 20, 30 years? What is the plus one standard deviation, minus one, the plus two, and minus two? And now I'll look at this and then I'll see where we are now at this point. And then I'll decide, okay, then do I want to like put in more, put in less? You can do DCA, but you can also do bigger sums of DCA at certain times when you think or believe that it is undervalued, right? And that can actually give you even better returns. So right now, I actually think it's very, very overheated. It could still go up. Yeah, sometimes momentum comes into play, right? But it's not there's very little margin of safety lah. That's how I see it. So I feel that there are better ways to get other margins of safety, which is through individual stocks. So that's where I'm shopping right now. Okay, so it's not that I will never invest, but the key thing is that when because I have the ETF, the indexes portfolio, and also the individual stocks portfolio, right? And in deciding where to put more on, I would gauge based on the valuations at each different point in time. So, like during the crash, SPX was an easy thing. Okay, when it dropped, as you can see from this chart, when COVID happened, it fell below the 3-year average. It almost touched the negative one standard deviation. So if you put in a lot at that time, your return is very good, right? And then as it shot up, right before the tech crash came, like if you DCA all the way, okay, but you could have put back on your DCA once it crossed the plus one standard deviation, and then that would have been less painful when it crashed, but still continue going. You get what I mean? So it's about like putting a bigger sum at work each time based on where the valuations are. And today's valuation, I feel, is yeah, it crossed the plus one standard deviation already. So I don't see a lot of margin of safety. I'm starting to pull back there, but I will put the spare cash to work in individual stocks. And that's what we're going to talk about, right? Like how I find those stocks, the winning stocks, the track records, as well as how I actually analyze it. Okay, so that's the indexes, the ETF portfolio, right? The other one that I think is gaining a lot of traction in recent years is most people are now investing in robo advisors. Very easy, automated. Okay, but I think what I see from people who write negative reviews from online about their robo advisors, right, is that either they entered at a really bad time, or they did not understand or they misunderstood how the robo actually works. Yeah, so I have done quite a few reviews of different robo advisors on my blog over the years because I like to explore whether a solution is good for me or my friends. And then when they ask me, I can answer, right? And my blog is like my diary of all this research that I put in. So I want to just point to this stash away example because I actually knew of and I met the stash away team very early on. I tried to understand how they were doing it, but when they described it and then I was looking at the online data as well, right? I mean, I spoke to the team and then look at the online data. It wasn't something that I could agree with. Yeah, I felt there was a lot of gray area that I couldn't really quite pinpoint, and then I decided I don't think it aligns with what I want to invest and how. So I didn't touch that, and there's a reason why you don't see stash away review on my blog. But I was reading these two customer reviews, and you guys can check out the links are at the bottom there. So the first one, right, on like this person said, like, I am quitting because this is my 4 years. No, this is my crucial realization of how my stash away has performed after 2 years. And she focused on how it's negative lah, negative 1,000 for the net deposit of 20 plus K. Okay. So when I look at it, I'm like, okay, it's really that knowledge gap of not really understanding how that robo works. And then this LinkedIn has a really great breakdown. Okay. So in July 2021, for example, Dashaway and some of these robos, right, it's actually a bit active passive. So they have their own approach, they have their framework, they have a way of thinking towards the markets that they apply, and they use their analysis to structure and rebalance your portfolio. So you need to understand what is their approach and their methodology. And then if you agree with that, that robo will be good because it helps you automate and less work for you, right? But you need to understand what's really being done with your money. And I think that's the gap because most people just, oh, robo, easy, convenient, but they don't really understand what goes behind it, or like they just look at robos in terms of the cost. But Kelvin, you've done that comparison as well, right? Every robo has different costs, but the solution also is different. The way they structure the portfolio, what the underlying instrument used in each portfolio is also very different. So Stashaway made several moves. The ones in rates are the ones that, on hindsight now, we can all know that was a wrong move. Okay. And then the green is like, if they had done it right, what would have been the result? So this is quoted from the LinkedIn review. Okay, and I think this is really something that people should deep dive more into before you park your money to a robo advisor and automate that. Do you really understand what is being done with your money? Because if you buy into that philosophy, that rebalancing, then when they do a rebalance that you disagree with, well, but you bought into that philosophy. You were the one who gave them the authority to act for you using your funds based on their thoughts. And if your belief and their investment philosophy clashes with different, well, then you got to change your choice, lah, right? So this is one example. And um, the other thing also I think most people don't really understand is that robo advisors charge a fee based on the assets that you have with them. So what this means, right? Now, typically the rates go down. The more money you put with them, the cheaper the fees. Okay, but there are still fees involved. So when you add up these fees, right, it does impact your portfolio. Okay, it goes closer to, I use 1% as the benchmark. Okay, so at the end of the day, it's like if you DIY through like IBKR or Mumu, Weibo, Tiger, if you do it yourself, okay, you are going to remove this portfolio management fee because you just pay the transaction fees, right? But when you put your portfolio with a robo advisor, that whole portfolio will be charged management fee. Yes, it's very low, but as you grow and you invest more and more and more money, the fees you pay is going to get more and more. So in the beginning, we don't put a lot of money. Often we put like maybe 10K, 20K, 30K. So the fees look palatable, but we all want to invest for the long run, right? So as your portfolio grows to 100K, 200K, 300K, just remember that your fees are also going to grow accordingly. Percentage drops, but the amount does go up. Yeah. So that's another factor to consider when you pick or decide on a robo. Okay, and timing I mentioned earlier on. So someone from Provident actually did a really great blog post that showed the timing of when you entered. Okay, and I was seeing a lot of people writing online like, oh, I hate robo advisors. Learn from my mistake. Never invest in robo advisors. And like, no, it's not that robo advisors are a bad instrument. It's that you invested at the peak of the market. Of course, your returns are negative, right? And I try to explain like I have friends and people who like ask me, Don, is what do you think of this robo or that robo, the portfolio? And then I'm like, why? And then they say like, I think it's really bad. Like I lost money. I'm like, okay. When you say you lost money, why do you lose money? And they cannot explain. Then okay. And if their friend or relative are like, show me your portfolio, I'll go and see when was the capital injection done. Did they do DCA, right? Or was it like a lump sum and then it was like near the market peak? And then we're now at like the tech crash, and you're saying that negative, the robo sucks. But no, it's the timing, right? So the strategy and all that needs to be there. Then you will get the result from that strategy, and it's not necessarily that the tool is bad. Okay, so these are really insightful stuff. I put the sources there. Please go and read up if you guys want to understand more. Okay, so at the end of the day, how I invest, and Kevin, this is really the whole genesis of this whole chit chat, right? You wanted to know how I do it. So these are just some of my past buys and investments. So for example, I bought this M stock in 2018 at 170. Then now it's actually not really yesterday, like a few days ago. Yeah, now it's at here. So this is how I go for it because that's where I can get better returns than just investing in the market index. Yeah, but I have to acknowledge first, this does need work lah. We need to run numbers, we need to crunch, we need to read annual report and understand the business model and basically just understand more about the company and the stock. Okay, so this is what I've done. And for those of you who are interested, I actually do share all of these on my Patreon, which is at nas.io/SG Budget Babe. So I will write each month about what I bought that month and at what price and why. And I'll put in like the pros and cons, what I see in what I spotted, what I understand of the business itself, what's the mode, what's the competitors, where is the growth, where are the risks, and what will it take for me to sell if I can spot all. Sometimes I don't know what I don't know yet. So if something bad happens next time in the future, which affects that fundamental thesis, right? I go back to the reports. I'm like, oh, this thing is no longer valid, or this thesis is now being threatened because of this. So then I may use that to exit the position. So that's how I invest. Of course, though, that page looks very nice, but let's get real. If I look at just last year, right? Last year in each of these months, this was the industry of the stock that I identified. I want to focus on the red color part. So there are losses. Okay, definitely will have losses because not every stock that I identify as undervalued may perform or recover its value in the same time frame that I'm tracking. So what I do is, because it's long term, right? Then if I can hold and the fundamental thesis is still intact, I will hold. But if it has broken, then I will exit and find a new opportunity. So while it looks very good, the green part is like, oh, not bad, green, oh, 2 digit, 3 digit return, but also got negative 21% returns. Yeah. So if I still hold on it, it could either go down, up, sideways, we don't know. So I make a decision as time goes by. But the key thing is that I want to show at the end of the day, when I dedicate all this time and research to really picking stocks, the bad do outweigh the good. Yeah. And the returns, like in 2023, okay, when I was tracking this, the gains that I made from even the bad calls, right, the ones in red, okay, the total was 40%. In the same year that S&P 500 returned 25, STI returned 5%, and Hang Seng Index returned negative 14%. So I think there is definitely a case to be made for stock picking and multi-baggers. So for those of you who relate to what I said, where you want to beat the market, yeah, for looking at individual stocks can help. Okay, so how do I do it? Right, Kami, that's what you wanted to know, right? I'm gonna be boring and naggy first and say it goes back to wait, did my slide just disappear? Hang on. Hang on now, wait, what happened? Where did the slides go? Hang on, let me go back. Okay, got it. Back here. Okay. So how do I do it? I'm going to be naggy and go back to basics first. You need to go step by step. So the ability to tahan all this volatility of the stocks, right, really comes from having that base being taken care of. So in terms of debt, the only debt I have now is my mortgage. I don't have any student loans or credit card debts. I have all my insurance taken care of. So I know even in the worst case scenario, I still have something to fall back on. I have savings. I have emergency funds taken care of. They're parked in the MMF. They're parked in T-bills. Some in endowments, some in SSB. Okay, so they're around because I keep adding, right? And then because all of that is taken care of, and then my investment, the fundamentals, which is the market indexes, the ETFs, and then I can go into like the stocks. Okay, so it's a ladder up approach that I use for my own case. Okay, so how do I calculate and how can you know if a stock is undervalued? So we're gonna use the Max 7 as an example. Okay. I think quite interesting because this is where the S&P 500 is, and the Max 7 is deviating. For those of you who saw my recent reel, I pointed this out on my Instagram and TikTok that Apple and Tesla and Google have been underperforming the S&P trajectory, whereas the other four have just been trending upwards. Okay. And I'm going to do a live demo now on Apple. I know everyone wants Nvidia, but don't want because I actually think Nvidia doesn't. I have very little margin of safety. I ran quick numbers. And I was like, okay, I don't want to. I will look at it another time when I see an opportunity or when bad news come, it crashes. But now, no. But I'm looking at Apple because number one, as you can see, it deviated from the S&P 500 trajectory. So that is one sign that could it be undervalued? Then the next sign is it's all bad news for Apple right now. And Kevin, I think you're asking me like how I spotted Meta, and I so daringly said that Meta was so cheap, like 1.5 or 2 years ago, right? And it's the same thing, like at that time when I said I put out my Meta thesis on my Patreon, right? not.io/SG budget babe. I put it there, and I was talking about I was doing some quick mode analysis and comparisons with relevant peers, and I remember that period the news was so negative about Meta. They were all saying things like Zuckerberg has gone crazy, he has lost his touch, Metaverse is burning, it will be the end of Facebook, and it was just very, very negative. And the news on Apple is also negative right now. And I tend to look out more during such times because the negative sentiment can make the stock potentially oversold. So all I do is I just wait lor. I run the numbers, I see, then I wait for a chance to go in. And if it doesn't hit the number that I want to, then never mind. I wait for the next opportunity. Yeah. So what I am seeing now on Apple is, you may have known if you have been monitoring. They just got the new lawsuit thrown at them, right? For monopoly, by the DOJ. Okay, so it's quite a major one. And then they're saying like, oh, Apple without AI looks more like Coca-Cola, so boring. You know, they're not really high tech. Why are they in Mac 7? And then they are paid, almost $500 million to settle claims that they misled investors. And yeah, just really bad news. So different from the days when Apple was holding up the S&P 500 and was like the darling stock. The sentiment has changed so much, and I like to go shopping at this kind of periods. So, okay, let's look at Apple itself, right? So, what is Apple worth? Well, if I look at operating margin, it's actually quite good news. What I want to see is that Apple have a moat that allows it to keep standing out above and beyond its competitors. Okay, and the operating margin is solid. Okay, the free cash flow margin is also pretty solid. They are quite good with capital allocation and investing it for returns, because the ROE and the ROIC are also very good. So in terms of financial health and the metrics that I'm looking at, they are ticking all of the requirements. Okay. And then I look at the EPS, the earnings per share. They have steadily been growing their EPS year on year, which is great, because that will lead to rising stock price in the long run that follows earnings growth. Right. And also this is better value and returning back to the shareholders and investors. So I do want to see, and I like to invest in companies that are actively growing their EPS. Question is whether it's manipulated lah, right? So, and we need to exclude like one-off events. So Apple is great, it fulfills, right? Free cash flow also looks pretty good. It's healthy, it's generating cash, it's positive. Okay, and yeah, the numbers, the metrics look great. So when I look at all these, I'm like, hey, it is actually fundamentally quite sound. Okay, of course, this is the math part of things. Before this, I would have already go and look at how does Apple make its money, what are the revenue generating pillars that it has. Okay, not just from iPhone, iPad sales and all that kind of stuff, but also the services element. How many percentage is it? What is the mode? What are the competitors? How are they preventing others from coming in? What advantage do they really have over the others? What's the replacement cycle of iPhone, so on and so forth. So I'll look at all of this, and on that part is already done. So then I will look at the financials, and it looks good. It fulfills my criteria. So okay, all is great. Okay, so then I will look at, okay, then question, is it undervalued? So Apple is a established company already, and because it has positive earnings steadily for the last few years, right, quite long already, the history. So the PE ratio, the price to earnings ratio, is one that I use as a very quick one, because lazy lah, huh? You go into Google, you just type Apple share price, Google immediately feeds you the PE already. You don't even need to do any math or thinking. It's like there. Okay, so I will look at that as the first metric, and then I'll see like, okay, so Apple share price now. Okay, and then Google tells me Apple PE is 26. Okay, then I look at, okay, what about Nvidia? Nvidia's PE now is 79. Oh wow. Okay, let's look at other of the other Mac 7. Microsoft is 38. Okay, also much higher. Let's look at Meta. Meta is 33. Okay, so it's all 30s, and then Nvidia 70 all the way up there, right? Apple is 20 something. Okay, then let's look at Alphabet. Okay, Alphabet is at 27. Oh, okay. So PE wise is more or less the same as Apple. Okay, what about Tesla? Calvin's favorite. Tesla PE is 39. Okay, but Calvin, I know you're going to tell me that cannot use PE to value Tesla, which I agree with. So, but I'm just using in context of Mac 7, right? So where does Apple stand on the Mac 7? Actually, PE wise, it's a short and fast way to see it could be undervalued or fair valued. One tip I learned in investing for the last decade plus, right, is that when we read the Intelligent Investor and they say things like your PE cannot be more than 15. Wow, cannot. If you apply PE cannot be more than 15, all these stocks are all automatically out already. Okay, so I realize cannot just take at face value. Also, we need to adapt and see relative. So relative comparisons are important. Oh, and I forgot one more. Amazon. Amazon is all PE 61. Okay, we'll probably need to investigate more why that 61 or 70 something for Nvidia is justified. I know the reason for Nvidia. Amazon, I haven't looked at it in depth enough in recent times. But yeah, so from PE perspective, we can see, hey, it looks okay. Now, then I look at Apple's historical PE. Right? So I compare to the peers already, Mac 7. Now I compare to itself. And historically, I can see Apple's PE is not at the highest now. So, oh, maybe there's something. Okay, but you all will see over here, right? If you look at the cut off, on the left side, it's more or less trending in that zone. And then like after 2019 onwards, right, it's like at the steadily above 20 already, never dropped below 20 PE. So I will then check why what happened. Okay, I actually I remember lah because I invested in Apple very early on also. I think 2016 or 17 I already invested my first Apple. So I remember that was when the service element really started kicking in. So now that services back then was so small, right? And Tim Cook was saying that is going to be the next growth pillar, and lots of people are very skeptical. But now we're at a stage where we know services is really, really bringing in Apple a lot of money. So you see the PE then adjusts already. It doesn't go below the 20 line anymore. But now that the DOJ is slapping that lawsuit against Apple's for the, and it could affect their services revenue, that's why investors are worried, and that's why the stock price is moving down. So could that be an opportunity? Let's find out. Okay, so the other one is, okay, I don't really like forward PE ratios because I feel forward is the future, right? And none of us really have a crystal ball. But since the analysts, and there are data analysts who crunch all these numbers, and you can pay for both free and paid services, okay, I will just see like, oh, what are they saying about the forward PE? So based on forward PE ratio, the Apple 5-year average is at about 26.3. Now it's about 25.7. Okay lah, there. Maybe not really undervalued, but there. Okay, so this is my first thing that I work with. Okay, it doesn't end there, of course. Not so straightforward. Okay, then I use a calculator. So I will run what I use to analyze for each stock, right? Will really depend after I understand the business model. Then I know what is the right metric to use. Like, we all know the wrong metric to use on Tesla is PE. But Calvin, what? Actually, you do have quite a bit of Tesla, right? Other than your belief in the company, and you really understand Tesla a lot more than me. What would you think is the best metric that you would use to value?
What was it? Wow, I also don't recall. That was like I did it 2 months ago.
Hmm.
Uh, I did. I, it's probably like free cash flow kind of thing.
Okay, not price to sales.
Not free cash flow.
Was
Yeah,
it
I
PS?
don't recall. Yeah.
Okay, yeah.
It's
So,
something else because free cash flow it fluctuates quite a lot.
mm,
Every quarter, so you can't really use that also.
yeah, and PE was pretty bad because Tesla was unprofitable until like, was it 1.5 or 2 years ago, right? Yeah.
Yeah.
So I remember reading all the initial during the COVID lockdown, people were saying cannot invest in Tesla. PE is terrible. But I'm like, but you're not supposed to use PE to value Tesla. And this is coming from me who doesn't know Tesla in depth enough to be able to say that. Yeah, so understanding which metric to use is also important. But for Apple, PE can work. So we've done the PE analysis already. Now I'll go into DCF. So for those of you who don't know DCF, it's actually not my favorite because I'm lazy. But I do have an Excel sheet lah, so I just plonk in the numbers. Again, I'm going to do it live right now so you guys can see how I do that. Okay, and what I do is, so I actually the yellow parts, right, is the one that I need to fill. So when I do this analysis, I'll plonk in the numbers in yellow, and then the blue will automatically be calculated for me, and then I will pay attention to the bright yellow and orange part lah. Okay, so I'm going to demonstrate that right now. Okay, let me stop. Change screen. Okay, so to get the, okay, let me. Yeah, okay. So I will need to first pull up my spreadsheet. Okay, and then I will, yeah. Okay, here. So this is my spreadsheet. Okay, so I'll put in the free cash flow, and where I will go to take that is basically from Yahoo Finance. Yeah, free. Yay, free data. But got downside. Wait, I'll share with you guys in a while. So on Yahoo Finance, I will go here. Is this my here. Okay. So over here on Yahoo Finance, okay, I will go to the Apple itself, right? Then I'll click on financials. Okay, then I'll click on the income statement. I like to look at annual, but I have friends who track it quarterly. So choose the one that makes sense for you. Okay, and then what I do is I monitor quarterly news, and I try to read the transcript and the earning calls, but I don't follow everything so detailed. Okay, but then when I run my numbers, I like to use annual, and ideally the most recent lah. Okay, so over here, what I will do is I will actually go to the cash flow, and I will go to the last line, which is free cash flow. Okay, so I'll take these numbers here, and I'll plonk them into my data sheet. Okay, so 2023 was the last annual report, 99. Okay, I will put that into my sheet here. Okay, so I'll put it over here, 99, which I've done here lah. Okay, see, here you can see 99. Okay, so then I will put in, but the problem is only last 5 years, right? So where do you get the last 5 years then? Okay, there is paid services, but budget babe. I find free, okay? I share my free resource. I use this macro trends. Okay, over here. But macro trends is not so nice, the figures. So what I have to do, okay, is that actually no like it's over here, see? The free cash flow annual. Yeah, so I'll just take the numbers here, lor. Da 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 da. See free, then you go all the way to 2009. No need to pay. Actually, I also got pay lah. I use Seeking Alpha also. I actually pay quite a lot of money every year for all these paid data services and charts and stuff. But for free, for those of you who don't want to pay for all these services, I also found free for y'all. So macro trends over here, you can get all the free last 10 years cash flow. Okay, so we're gonna plonk in these numbers up to the 45. Okay, and then you'll see it come out on my spreadsheet here. So over here, right? Okay, I'll plonk in here. Okay, 45. Let me replicate. So I'll put in here. Oh, sorry. Wait, copy paste got error. Copy paste. Okay. So you see, once I put that, put again. Ta-da. So a lot of fields get auto-populated for me already. Now what I need to do is I need to look at the growth rate. So based on the numbers that have been put in, I can see also when it was negative, okay, and then when it was positive. Actually, I should color code green, but never mind. Okay, rate more important. So based on the growth rate, then I will choose what is a good growth rate that I can go with, and this is where you can make your assumptions. Okay, so if you are very bullish, very optimistic about Apple's future, maybe you want to use like 10, slightly above the average. Okay, then it will calculate. Okay, or maybe you want to be a bit more conservative. I want to do 8%. Okay, so you can do various one. I actually use 8 in my calculations. Okay, so then that will you see wait. Yeah, so based on this, okay, this is actual. Once I input, what you all must see is that the projected will now change. Okay, so I'm going to use 8. I want to be a little bit more conservative than the average, and the numbers are now lesser. If I go for a higher amount, you can see the terminal value and everything has gone up. Yeah, so I rather be conservative. Okay, but sometimes conservative, then you miss out on opportunity. So you must balance lah. Okay, so then for those of you who are wondering what terminal value is, if you are not familiar with that term, basically what it refers to is the value of all the future cash flows of the company beyond the forecast period that we're using. So we need to estimate the present value of this future money. Okay, back into this. So cheap, never mind. That's why I use Excel. Okay, this is the formula. So y'all can build your own Excel sheet if you want. Otherwise, if you want to steal this off me, I'll share you guys later in a few minutes where you can get it. Okay, so then the next thing I want to do is I want to put in the sum. Hey, why my sum the formula disappeared? Formula disappeared. Let me copy and paste. Maybe I deleted something just now. Okay, so I'll put in here. Okay, so it will calculate for me what is the sum, correct? So you see, once so once I put in here, it will calculate for me what is the sum of the free cash flow by adding everything up. Okay, then I need to go and get the cash and cash equivalents. So where I go to get that is quite simple. I go into the cash equivalents, right? Oh wait, sorry. I need to go for the debt first. Okay, the debt. So where I go for the debt is also Yahoo Finance free. So it's over here. Okay, Yahoo Finance. Okay, wait, I can delete this page right over here. Okay, so now I need to go for the debt, right? So on Yahoo Finance over here, I will go into the balance sheet. Okay, and then again, I'll put in annual, and then you can see the annual debt. Okay, but since I am doing it in March and their annual report was in September, so we're about 6 months over already, right? What I want to do is I go for the latest quarter then, and I'll take this number 108 and I will plonk it into my file. Okay, so go back to the file and I'll plonk it in here. In like that. So I take here already lah. Okay. Here. Okay, so after that, then I will put in what is the cash equivalence, and I get that. Wait, I need to go and get the number of shares outstanding also. Okay, so where I will go is I will go again on Yahoo Finance. Here. Okay. I'm not very good at switching screens here. Okay. Under Yahoo Finance, right? Under the statistics. Okay. Earlier on, we were at financials, right? We were at cash flow, we were at balance sheet. So now I go to statistics. Okay. Here. Statistics. And then I will just go and see the shares outstanding. 15.4 billion. So I will put that in. Okay. And I will plonk it. 15.4. Where's my share screen? Sorry. I'll plonk it here. Okay, 15.4. Because I use in millions. Okay, last thing I need to key in is the cash equivalent. So I will go to the latest quarter. And again, I use Yahoo Finance. So I will go to Yahoo Finance. Cash equivalent would be in the cash flow under financials. Okay. No. Where was that line? Hey, where did I get the thing? Hey, never mind. I type in the comments later. I'm a bit confused really because I keep switching screens. But anyway, let me go back to the Excel. And I'll share all of the links for the macro and Yahoo Finance later on, so y'all can redo this yourself. Okay, so over here, okay, so I will put in the cash in the latest quarter.
Don is in the balance sheet. You open up total assets.
Oh
Then
yeah,
current assets.
yeah. Oh my goodness, yeah. Why was I? No wonder I cannot find on the cash flow statement. Okay, so let me share. Let me pull out again. Thanks, Calvin. Too late already. What time already? 11:20. That's why. Okay, thank you. Yeah, no wonder I cannot press. Yeah, sorry. Balance sheet. Okay, so cash under total assets, and then under current, and get the one yearly. Here, cash equivalents. Yeah. So put that into the Excel sheet, and we will get 73,100. 73,100. Okay, so now I will end up with, and by no means my DCF is perfect lah, because the assumptions also matter, right? Like you might differ in terms of the growth rate, so on and so forth. But now I have put in already. Okay, so the cash equivalent is 73,100 from the balance sheet, and that will give me the intrinsic value of 179. So then I'll put in what is Apple's price today is about 172.4. So I'll put in 172 and I'll see like, oh, okay. So if my calculator based on 8% is telling me that it's 179, it is undervalued. So okay, not bad. I can go for that. Okay, so 172. Let me 172 here. Yeah. So if I want then like a 20%, so the difference is basically this minus this. Okay, and then if I want a 20% margin of safety, okay, I will put that. So what is my acceptable buy price? So it's this one times 80%. Okay, so my acceptable buy price is this if I want 20% margin of safety. So then I will put in my notes for myself what price I want to buy at, then sell at if I know. Usually it's to be confirmed because I don't know what the future holds, right? So that's how I would run my DCF. So okay, the cleaner version of it is over here. Okay, and I run also like different growth rates to check what the different intrinsic value would be accordingly. And then I see what is the upside at current versus current market price if I were to go in. So this is how I will come up with what I want to buy at. So based on using 20%, I may want to wait until Apple falls to 150, because I think 143 maybe quite far. Maybe I want to wait until 150, and as it inches closer to then I will move. Yeah. So any questions? Confusing at 11:20. Okay, no, we can go to questions later on, but let me go back to the slide now. So going back, yeah, these are my sources lah. Okay, so but to be very honest, my biggest issue with DCF also is that I mean the Excel helps to make it faster and easier, but at the end of the day, the values that we put in for the assumptions, right? I like to say this when I discuss DCF with my friends: rubbish in, rubbish out. So, and I also think sometimes the things I put in rubbish one, because maybe my percentages are very off from the reality of what the company is, especially if I haven't studied it in depth enough to be able to make a good assumption of what that number should be, right? So that's one. The other thing is also that the DCF model, because of how conservative it is, it focuses on cash flow, discounted cash flow after all. Fast growing tech stocks or unprofitable tech stocks that have not yet turned a profit, like Tesla last time, it would be excluded. So that you will miss out on a lot of stocks if you only use the DCF model. That's why I use the DCF with the PE. Okay, but then if it's not like a Apple like stock, then maybe I use PS, I use other metrics. Okay, and the other thing about DCF is that the intrinsic value calculation, right? Don't take that as a hard and fast rule, because it doesn't account for non-financial factors such as the strength of the brand, the management quality, how great a leader their CEO is, how they can rah everyone to really like pour their hearts and soul into working for the company, how they can, make very good public facing statements that will lend to the bullishness and the sentiment of the stock. Okay, and how they can navigate crises. Okay, and as well as any moods that the brand has. DCF doesn't capture that. So good to use DCF, but there's also a trade-off lah. Okay, and the key thing is like do this only after you have confirmed the stock is a great business with strong fundamentals. So every time my friends or my readers ask me like, "Hey, Don, what's the intrinsic value of stock ABC?" I'm like, "Wow, number one, that stock might not be on my watch list. You expect me to go and count every single time? Is it? I'm not like a data cruncher. There are paid services that will do that for you, and I'm not one of them, right? And the other thing is that you should only be doing it after you already really understand why the company is good in the first place, or you've done that first step, and that's where I see, hey, I like the business model, I like how they earn money, I like the management quality. I do see a mode, or I don't know whether there's a mode, but the numbers seem to suggest there's a mode. Then I'll try to dig deeper and find out. Once I've cleared all of that, right, then I will go and do the math. Yeah, I always do the math as the last step. Okay, so that's how I will calculate. Okay, and then there are different valuation models. So there's DCF, there's price to earnings, there's EV, EBITDA, there's price to earnings growth. PB, usually for the banks, there's also price to NAV. I forgot to put that here. Price to sales, price to free cash flow. So there are different metrics and valuations that you all can use. Use the one that makes sense for that stock, that industry, and for you. Yeah. Okay, so okay, that's it. So if you guys want to steal my DCF model, you can buy me lunch. Then I bring my kids out. Okay, you can steal my Excel sheet, and you can actually put in the numbers for stocks that you are interested in to calculate your own intrinsic value and put in the different growth margins and margin of safety, and then come up with a number that makes sense for you. So because we're doing this with Kelvin, I will give a discount code. So if you are getting it because you're watching this video now, you can enter the discount code half price for Cal DCF and get 50% off. Yeah, Calvin, I'll give you for free. Yeah, and then if you want to write on my homework instead, okay, what I do is, so everything that I talked about earlier on, right? This is like the reports that I write and share. Yeah, so this is where I will do all that fundamental analysis. I will write, and then I will talk about it, and then I will explain the pros and cons, the growth, the risk, the trade-offs, what will make me sell the stock if I see potential risk. Then if this were to happen, okay, that will break the thesis, and I may then liquidate the position, or I may then sell. So I'll write those kind of stuff for record keeping as well. So I do share this on my nas.io site, and you can read that report to help you shortcut the amount of research. Yeah, it's not meant to be financial advice because again, I don't know you, I don't know your circumstances, I don't know what you're looking for, your portfolio. If you're overexposed, doesn't make sense. Everything also tech, then super overexposed to just one sector, right? You need to make those decisions yourself, but it's to shortcut. And to be fair, I also do buy reports like that from others. Yeah, so what I do is I will read all those other reports, right? And then I will digest that and I curate from there. So I subscribe to like Motley Fool, Seeking Alpha, and a lot of like, Substacks here and there to basically get their insights. And then that's where I get my winning stock ideas as well. Sometimes it's from seeing things around me. Sometimes it's because friends told me about it. But sometimes it's really just writing off someone else's research. Although my gripe is maybe I'm just too anal, but I find a lot of the times when I read the ones that I subscribe to, they are very, like, they don't go in depth enough. Yeah, like for example, the Motley Fool paid reports are a good starting point. But I find that when I read that and I am, oh, this is an interesting idea, it's not enough data for me to be able to make a decision. I still need to do like maybe 60 to 70% more work before I'm done. Yeah, so I try to make mine like, a 90% thing. Then the only thing you need to think of is like maybe you have different assumptions, then you run different numbers, or you look at how it fits in your portfolio. So it's a bit different lah, but that's where I share my research. And then yeah, this is when Meta, for example, right? I wrote this because I was looking at, you can see, I talk about how back in April 2023, Meta price to earning ratio was actually 20. It was in 15 before that, but I missed the bottom because at that time there was a lot of uncertainty and I myself wasn't sure. But then by April, things seemed a lot clearer. So the price to earnings ratio I saw then was 20, and this was all the reasons. And then I was comparing it to Adyen, and I was like, Meta is super cheap, really super cheap. And yeah, you look now, fast forward with hindsight knowledge, Meta is just surged like crazy lah because people start to recognize the value. Mark Zuckerberg is no longer seen as crazy, right? So yeah, that's my track record, and y'all can go and see which one makes more sense for you, or just take what you've learned here and replicate on your own. Completely free resources, Yahoo Finance and online, and whatever makes more sense, that would be the one. But yes, does that help answer your question, Kelvin?
Most of it. Yeah, actually, I more or less know things here and there, but yeah, this puts a better way to connect everything together lah.
Mm. Yeah, for sure. Oh, hey, your readers are asking, do you have your DCF Excel that you want to share instead? Yeah, then don't use mine, use yours.
Yeah, actually, I made a video in the past lah. I can, you guys can search on it. It's somewhere on YouTube.
Okay, so y'all can go and find, and then you can use his DCF model instead of mine. Yeah, I think it's slightly different. I tweak my model to put in a lot of the extra stuff y'all can see where I put in price, the difference, margin of safety, different growth rates, what I want to buy. So I tweak it, and then that's the value add. But if y'all want something simple, you can do your own DCF model for free also. Just build your own, then just prettify it yourself. Yeah, but if you don't want and you want to write off my research, you can just treat me to one lunch, and then you can just download my Excel sheet. Yeah. So yes, maybe should we do Q&A now?
Yeah, if you guys got any questions, can just ask lah.
I see. Wow, actually so much comments. I don't know where to start. Okay, I see. Wow, Kevin, where can sign up for Dawn's Robo Invest launch? Never. Never. Go and choose your own and set up your own Robo Invest. Calvin already taught you all how to do automated investing setup. So go and do that. And I always think we should be custodian of our own money. Right, Calvin?
Yeah, so the thing, what I realized like is that I run a podcast. Then one of my members, they said, your money will only work as hard as you. So meaning like if you, let's say if you see some crypto like the crypto 100x because maybe someone was shielding it, yeah, that's how you discover the crypto. But if you never do the
Mm.
research, right, you just buy blindly, chances are you'll be losing money. So I think is I think Don makes it look super easy, but I can assure you it's not that easy.
But it's
Uh,
also not that hard.
yeah, so there's a learning curve lah, basically.
Yeah.
So if you want to pick stocks, right, you either have to do your research or you have to trust the person who is doing the research. Like maybe for if you want to buy Don's lunch. Then you have to
Yeah,
trust that the work that she does
or
is
question.
legit lah. Yeah.
Yeah, actually on my NAS IO the reports, right? So I do get questions like why you use this number, why you never factor in this. And I love that. So then yeah, it's a discussion. Then we can see if that makes sense, or I can explain why I didn't pin as much importance on this. And it helps, right? Because some people pay a lot of focus on like the company must be profitable first. Then I will invest. That's fine, right? It's your perspective. But then hearing from someone who is choosing to invest on a loss-making company before it becomes profitable, then that person who went in before it become profitable will make a lot more money, right? So hearing different perspective, I think it's always good as an investor. I really hate doing math, so I built this, and my struggle with earlier DCF models was that I couldn't get a clear action out of it. Like I would run the math. I'm like, okay, so this is the intrinsic. I've done the assumption. My assumption good. So I tweak it to put like very clear signals for myself what I want to buy at and what I want to sell at, and what are the growth projections that I'm using in to justify me buying in at this point and changing it that way. Yeah, but I don't do DCF all the time. Yeah, I if I can, I like PE because it's just shortcut, it's lazy. But usually PE, like what I shared for Apple here, is that it's just the first sign to me that oh maybe there's something there. And I actually did think I was like, oh maybe I can buy Apple this week. I buy more. But then after I ran the DCF, I'm like, oh, I don't think I will buy Apple now. Yeah, I do still want to buy more Apple. Because I do think the bad news is very, very it's causing it to be oversold unless more bad news emerge. But it doesn't hit the number that I want it to be at intrinsically and the margin of safety that I demand. So then after running this, I was like, okay, I won't be buying Apple now. Yeah, but when I do, then I will do the whole report and then it'll be up on my page for whoever wants to read that and steal my homework. Yeah, but yeah. What else do we get? Dawn, do you have a tutorial for your Excel of my Benjamin? Oh, that's a good idea. Yeah, actually, Ben, that's a great feedback. Tell you what, this link I've just made the Excel sheet available on this link here, and then y'all can get it at half price. But yeah, I think I will do a tutorial for that. Then let me clean up and edit the video so it's not so jarring like just now. Yeah, I will edit a tutorial video and then I'll show where I get the free data. Yeah, so for those who are interested, and you don't mind to learn from me in this way, you can get this first, and then when the video is uploaded you will still have access because it's lifetime. But for those of you who are on tighter budget, please don't buy. Go and use Calvin's one. Calvin, you share yours or not? Do you have it on hand now? Then you can see yours.
I need to dig it up.
You need to dig. Okay.
But I can just share the link to that lah.
Okay, yeah. So Calvin's gonna share a link. Your budget, go and get his. Okay. Otherwise, you all can design your own also. Yeah. Okay. Other questions. Wow, Calvin, I see your fan. Sweet lah, Calvin. I love you since COVID-19. Wow, love confession.
Oh, please.
Can you share your top 3 stocks that are undervalued now? Go on my Patreon. Wow, this is tough. I can share why it's not undervalued. I think SPX is not undervalued now, and Nvidia is not undervalued, and Meta is not undervalued. But that's my view. Yeah. As for what is undervalued, there's a lot. Yeah, I think China is undervalued, but there's a lot of policy and government risk there right now. So it's not for everyone. Yeah.
For China, I think it's a bit like recency bias, the thing that you mentioned just now. So everyone like hates China.
Yeah.
But if you look at it, the way I look at it is like the government is doing things that are good for the people. That's why they are banning. Okay, so they start with the anti-monopoly thing. Then they could clamp down on the expensive tuition thing. Then previously they were clamping down on gaming thing. So
Yeah.
as investors, you will hate it, right? Because your all these stocks will crash. But actually, it's good for the people. So it would produce a net benefit for their entire country, kind of thing. So the way I see is that once all these things are resolved, including the housing crisis, which they are still trying to resolve, when all these things are resolved, guess where the stock is going to go after next? So it'll be a bit like currently is in the lost decade kind of thing. Once all these things is over, right? My theory is that it will go up lah. Yeah,
Correct. I
it
share
can't,
the
it can't
same.
stay down forever.
Yeah, in fact, in January this year, so just 2 months ago, right, my stock research that I bought, I wrote this statement, I doubled down, and that was a China stock. Yeah, so obviously that one, if I run the numbers now, it's still, I think it's flat. or maybe slightly positive, single digit. It's not going anywhere yet. But same. I think during these crisis times, right, it's when the good bargains are found, but it's very hard to invest. So exposure, I find, is one important thing to control so that we can still sleep at night. Yeah. So my China exposure now, I think for my stocks, my active stock pick portfolio part, right? My China part is, I think, 15%. Yeah, less than 20 lah. So if I lose it, then okay lor. Yeah, and other parts still do very well, as you all can see the track record lah. But yeah, if it really happens, then I can still sleep. I can still rebuild. But the folks who are going to there, I actually have friends who are 75% to 80% Hong Kong China. I think they're very daring. Yeah, but you see, when that wave turns, right, they are the one who are going to make a lot of money because
Yeah.
they went in during the
So I
crisis.
think the challenge is when, right? So it can
Correct.
be next year, it can be 20 years later. So I think this part no one knows when, because like they say what, the market can stay irrational longer than can stay stolen kind of thing. So if you keep
Mm.
trying to DC in and it doesn't turn within the next 5 years, 10 years, are you going to give up and go back to US again? Because by then US probably might be higher. So you need to be patient, or if something like China, especially if all these government kind of always disturb kind of thing.
Disturb. Yeah, and I think China also now, the smaller companies a bit more, it's very, very high risk now because they may not survive with all those interventions, and whether they have the financial power to tahan all the way, and their leaders are great at politicking to really stay afloat, right? I think a lot of that comes into play. So for my China picks, I pay a lot of attention to the mode that they have, the financial strength, the amount of cash that they can produce with the debt exposure. I don't want it to be too high, and I also pay a lot more focus on the management. Yeah, and management quality, unfortunately, the DCF model, no ratio in the world would tell you the value of the management quality. So that's where the fundamental analysis have to come in, and we have to read. What I do is I read the interviews. I read the letters, right? The annual report, the first few pages they will write, and then I will see the moves across the year as I monitor the news. Then I will figure out, and I'll have a judgment call of how good is this management, and then I will make a decision from there. Yeah. So that's for management. I see also in the comments someone is saying S REITs. Yeah. Well, Calvin, what's your view on S REITs? I do see quite a bit of opportunity in S REITs, and I think actually it was even better in the last 1.5 years when interest rates was going up. Then the REITs were the first to be affected, right? Because they are leveraged after all. And there was a lot of opportunity there. So I think people who are shopping around in the REIT space now, if you find good value, you can use that. Don't use PE. Yeah, REITs, to please do not use price to earnings. PB or PNAV, the dividend yield and all that is a better valuation tool to use than DCF or PE. Yeah. Kevin, do you see the same in S REITs?
Yeah, REITs for now, like even though the rates are going to come down, the REITs who are going to renew their renew the loan for this year. I forgot what's the exact term. Renew the loan for this year. They are all renewing the new loan at a much higher rate. So that's why
Finance.
REITs are refinanced lah. So that's why the REITs have not recovered yet, because their overall the interest that they have to pay is going up, and that's bad
Mm.
for them lah. But this also means that it's a good buying opportunity now for REITs. Yeah, I've shared multiple times lah. For me, I don't really look at the all the valuation kind of thing. My criteria for choosing REITs is a lot simpler than Don's way. Mine is just like, okay, dividend yield, okay, good. The dividend is increasing, okay, good. The stock price is increasing, okay, good. So as long as it fulfills this kind of thing, then to me, I would buy. I would just buy it lah. Especially right now when the price are a lot
Mm.
very depressed.
Can I add on one more metric so that instead of two things, you look at three things now? I would add on look at the dividend payout ratio.
Oh yeah,
Yeah.
dividend.
So if they are
Dividend.
using debt to fund and maintain their dividends payment, then that's quite worrying. And I say that because I have seen in my experience of investing, right? I have seen dividend counters that were paying above and beyond. And then one day the party just ends lah. Cannot tahan already. Yeah. So after seeing that happen, in the early first few years of my investing, I told myself I need to look at dividend payout ratio to make sure that this mistake doesn't happen again. I didn't get burned, but I know of a lot of people who did. Yeah. So yeah, okay. I think why people asking me about Man U? Is that the football team? I don't watch football. I don't know. Yeah, I think that's it, right?
I think just now this guy asked, someone asked about thoughts on EV makers. So about Tesla, I don't really like sharing about Tesla because it's quite polarizing. But since you asked, for me, Tesla is a lot bigger than a car maker, which which I guess a lot of people will find it very controversial. I say, oh, Tesla is earning like 85% of their revenue from cars. Why is it not a car maker? It's obviously a car maker. But if you look at the back end a bit, other than selling cars, they are also doing what? Full self driving. They also have energy. They are building up their energy segment. They they are also training their robot, which I think right now can sort stuff and can run around, this kind of thing. So even though Tesla is going down right now, I'm not worried yet. I have not done my Tesla shares because I see all these growth opportunities coming from elsewhere. Plus, Tesla is still profitable. Their free cash flow is still quite strong, kind of thing. Uh,
Mm,
I think that recently they also lowered their car price again. But all this just means that more people will buy the car, which in turn will train the full self driving, which in turn will make driving safer. So if you look at it like long term, right, Tesla will definitely solve full self driving just because they are collecting more and more data, and it has been proven that all this AI thing can make driving safer. So eventually, when all this become the standard, Tesla doesn't have to sell that much cars, right? Their revenue can come from services like Apple. They can do their it can come from their energy segment, can come from the robotics. So that's the bigger picture that I'm seeing from Tesla, not just selling cars. Oh, Tesla is lowering car price, they are earning less money. So I think that's just a short term thing. Yeah.
mm.
For BYD, I'm not certain.
We're already on top of the EV play. There's also the China risk, so it's two risks at once.
Yeah, for BYD is a bit more budget model, budget segment, which Tesla is coming out in, I think, next year or 2 years time. So that will sort of rival BYD in that sense.
Mm, yeah. So yes, I hope this was useful, and thank you for joining us at night, guys. Okay, any is that okay? Thank you, guys. Bye bye. Okay, let us know in the comments if you want to see any future content like that. But yeah, till next time. Bye bye.